as we go on. But Aditya Sood is with us from InCred PMS. Aditya, good afternoon. Great to have you with us here. I think we're speaking for the first time after the entire election results and the resultant sell-off and then the one-way rally. So I just want to start by putting that in context. Did you do anything last week? Were you able to buy anything? You were always someone who's looking at out-of-favor names, not really chasing the momentum at all. In all of the interactions that we've had with you, that's come out clearly. Last week, suddenly you had pretty much across the board sharp 20-25% sell-offs.
Sure. So I think so. We were very well placed, going into the election result, because we were sort of having an underweight positioning on PSUs generally. But what we were in a position to do is to augment our exposure in terms of, increasing our exposure to, names that we like. We have, increased our exposure to financials, because clearly post the elections, and that was getting reflected on day one, when we saw the result coming through, there was a clear cut moving of money in favor of, IT and FMCG, and consumer overweight positioning for us continues. So, I think so the complexion of the market in terms of, how the market sees sectoral rotation going forward is going to change. And, thankfully for us, last 2 months, we have been overweight on IT, consumer as well as, automobile. So that, positioning continues. Financials is a new one, wherein we are trying to augment our weights, in this environment wherein we see, again, a shift from possibly, money moving out from PSU banks in favor of, some of the NBFCs or well-managed private sector banks.
What kind of FMCG names are you overweight on? Are you playing it via the large listed players which are underperforming, or are you looking at the second rung names? Because FMCG is now seeing that schism as well. The mid cap IT, large cap IT names, similar is the kind of move that we're seeing in FMCG too.
So one of the themes that we like as an overall construct of our portfolios is that, we would like to buy great businesses when they have underperformed for a prolonged period of time. So clearly, if you look at the FMCG construct, be it a Dabur, which we obviously have a holding, and, be it a Hindustan Unilever, what we have seen here is that, the PE multiple compression is behind us in our view. And obviously, rural has not done well, and we have been playing this rural recovery theme for last 6 months. It started by our overweight positioning on, Hero Honda essentially. It spilled to now, companies like Barbecue Nation, wherein we believe that, it is going to be a part of discretionary pack. So I think so from a consumption standpoint, clearly we see limited scope for PE multiple derating from here on. Plus, there is also an element of, under ownership in a lot of these names because, clearly these are low beta names in the portfolio. So we have seen, fair bit of positioning, getting changed, and Dabur and Unilever have outperformed recently. But our view is that, any company on the consumer staple side wherein the go-to market is very, very clear in the sense that they have, invested a lot in terms of augmenting the go-to market or distribution reach for last 2-3 years should benefit. And what we have also seen of late is that the volume growth has started to, outstrip on the rural side versus the urban side. So I think so these are clear signs of, consumption stocks doing well going forward.
All right. Hi, Aditya. Good afternoon and good to see you in. This is Nigel on this side. There's this debate about consumption versus capex. I have a sell-side analyst, on cement, and he said, leave both of them, buy cement. And some of these cement stocks are doing quite well. That's a third C in there. As we speak as well, there is some optimism that maybe pricing has bottomed out, demand will come back, infra push, housing push. Do you all have any exposure to cement?
Yeah, so essentially, the large cap cement names, if you look at, possibly Ultratech or Ambuja, they are trading northwards of, $200 EV per ton. One of the things, which is a very, easy way to value cement is that, either you are in a, rupee devaluation environment, which clearly happened, post 2008 to 11, wherein, people were benchmarking. So the new benchmark for large cap cement, and obviously, the industry has consolidated. What we like in this space is smaller mid cap companies, which can be consolidation plays for the large cap companies. So if you look at, anything which is closer to 10 million tons in terms of capacity, that is what we have seen, getting re-rated over a period of time. So we believe that there is a huge consolidation play here. If you look at players in the South, particularly, what you'll find is that, a lot of the players are not making money at this point in time. So it is going to be more consolidation play, because ultimately what we expect going forward is that, there is a very simple roll-up which can happen in terms of multiples. So we prefer the mid-cap cement guys. Possibly our filter is 10 million to 20, 30 million in terms of pure capacity. And obviously, these should be complementary in terms of, large caps acquiring, the small cap or the mid cap cement plays.
You want to give us some names between the 10 to 20 million? We have a few that are flashing for our viewers on the screen, some large ones as well, 20, 50. But from the ones on screen, I can see JK Lakshmi Cement, Sagar Cement, NCL's too small, couple of them. You want to name any of them, Aditya?
We have only one holding. Obviously, this is a disclosure. We only have Orient here.
Orient,
what is
okay.
what is also very important alongside is that, how is the cost curve and whether they have, limestone reserve to last. I think so that is going to be the key, apart from the region.
All right, and that's on its way to that 10 million ton plus. Mr. Ketrapal keeps telling us that, from 8.5, we're moving to around 11 million tons. So we keep pushing him on that. And for the time being, he says the company is not on the block. So we believe him.
All right, so we'll keep that in mind. What about the fourth C? We've spoken about consumption, capex, cement, chemicals. A lot of people are believing that, the oversupply, the glut, because of which prices were lower, is now turning. Maybe demand is catching up, and going forward, this will play out in terms of prices for a lot of these companies as well. Usually a cyclical play, but where are we in the cycle according to you?
I think so. We are closer to mid-cycle. One thing that we shouldn't miss is that, the top 5 players are close to, possibly 55% of the capacity, but profit pool is something that needs to be analyzed here. Because quite like, other industries, the 70% to 55% capacity market share could lead to a 70-75% profit pool. So and obviously that is getting also reflected in valuations of large cap companies, because clearly there is a belief that, these companies will continue to grow and improvise on their, fuel cost or, the freight cost over a period of time. Obviously that is very, very critical from a standpoint of, looking at consolidation plays. So our focus is to focus on profit pool across the value chain rather than optically looking at, market share.
Aditya, on the capital market side, and I don't know if it's a cup of tea. You did mention financials, but I don't think you meant capital markets. But have you looked at that space, exchanges, asset managers, etc.?
Yeah, we have, we hold MCX basically. MCX obviously is a play of, financialization. And obviously it is a commodity play as well, wherein gold and crude, obviously it is in a monopolistic sort of a situation. 3 years back, there was a big debate that whether, MCX positioning is going to be, challenged by, either BSE or NSE. I think so. MCX is an excellent play. And obviously, we see a similar option sort of a story getting played out on the commodity side as well. So we have MCX in the portfolio. In the past, we have held, CDSL. The only problem with, proxy plays here is that, these companies are great stories from a 5-year standpoint. But the only thing is that, there is cyclicality. We have held CDSL in the past, but we don't own CDSL today.
Where do you stand on the entire PSU rally? I mean, one can't paint them all in the same brush, but you do have PSU Defense, you have some of the rail-focused stocks, then you have a bunch of PSU banks, then you have PSU financiers, PSU power financiers. Where do you stand there?
So we have held BML in the past. The rail story is something that we like, but obviously valuations are getting very, very steep here. And BML is something that we think is structural in the sense that, it is a one of its kind asset. Obviously, it was up for divestment. Obviously, we'll see how it evolves, post the new government coming in. We also have exposure towards, PSU financial companies, particularly on the housing finance side. So we own LIC Housing Finance. We believe that it is a cheap stock to own. OPEX growth is accelerating. The best in terms of, asset quality is yet to be delivered. The stock was cheap. Possibly they are moving towards a 1.2% ROA trajectory. The stock is under-owned by most. So we like the low-cost housing finance space. And this is again a part of a theme wherein, money is going to move from PSU banks to private banks. And within that, we like low-cost housing as a space. We also have exposure in a company known as FedFina Financial, which got recently IPO'd. We believe that it is a structural story. 55% of their loan book is a combination of, mortgages. 35% of their loan book is gold loan. Obviously, they benefit out of this NBFC turmoil on the gold loan side. The cost of their cost of funds is, close to 7.8. Obviously, they have a backing of Federal Bank as a parent. So we like, both these themes on the housing finance side.
Right, Aditya, thanks very much for that. We'll leave it there. A great conversation, lots of stocks and lots of ideas, at least in terms of what you own and, the rationale behind it. It's the moment of truth.